Start.
Students, today we are going to study application of cost accounting, variance analysis. Variance analysis is a key tool in cost accounting used to understand the difference between actual and expected financial performance. You see, how much did we expected from the company and what is the actual, you see, financial performance. It involves comparing actual costs and revenues to budgeted or standard amounts to determine why, you see, differences occur. You see, what were our budgets and what was, you see, our budget of revenue, what was our budget of actual, you see, cost, what was our budget of cost, but what actual costs, you see, occurred and how much, you see, actual revenue earned. So this difference, why this difference is, you see, there, this we have to study. This analysis helps, you see, management identify areas where the business is performing better or worse than expected, allowing for better control and decision, you see, making. By this analysis, the management, you see, further takes decisions, you see, takes action, how to improve the things and how to improve the profit, revenue. Variances can be, you see, categorized based on what is being measured. The primary types, you see, include cost variances, difference between actual cost and budgeted, you see, cost. What was the budgeted cost and what is the actual cost? Why this, you see, difference is there? Then revenue variances, difference between actual income, actual revenue, and, you see, budgeted, you see, revenue, say actual sales and, you see, projected sales, actual revenue, budgeted revenue, what was our budget and how much actual revenue did the company, you see, made. Next is, you see, profit variance, difference between actual profit and, you see, budgeted profit. What was our, you see, budget of the profit and how much did the company actually made profit. So cost, revenue, profit, these three, you see, variances. Here we study in cost variance, we study difference between actual cost and budgeted cost. In revenue variance, we study actual revenue, difference between actual revenue and, you see, budgeted revenue. In profit variance, we study difference between actual profit and budgeted profit. Cost variances can be, you see, further broken down into three main categories. You see, cost variance, difference between actual cost and, you see, budgeted cost. First is material, you see, variance. Material price variance measures the difference between the actual cost of materials and the standard cost, you see, multiplied by the actual quantity of materials purchased, you see. Now, why this, you see, difference is there? If the difference, actual cost is less than the, you see, standard cost, then our profit will increase, you see. And if actual cost is, you see, more than the standard cost, then, you see, profit will not, we cannot increase our profit. Then we have to multiply it with the, you see, how much materials did we purchase. Then next is, you see, material usage variance. The material price variance is MPV. Material price variance, in short we write MPV. Material usage variance, in short we write MUV. Measures the difference between the actual, you see, quantity of, you see, materials used and the standard, you see, quantity expected, multiplied by standard cost, you see, per unit. So material usage variance, you see, MUV, is, you see, the difference between the actual quantity of material used and standard, you see, quantity expected, multiplied by, you see, standard cost per unit. Next is, you see, labor variance, you see, labor rate variance. Labor variance means labor rate variance, LRV. The difference between the actual hourly wage paid and the standard wage, multiplied by the actual hours, you see, what that is our labor rate variance. Next is labor efficiency variance, we denote it by LEV. It is the difference between the actual hours worked and the standard hours expected to produce a certain level of output, to produce a particular that good, you see, that particular commodity, multiplied the standard labor, you see, rate. This is our labor efficiency variance. Next is, you see, overhead variances. In overhead variances, we study variable, you see, overhead variance. The difference between actual, you see, variable overhead cost and standard, you see, costs. That is variable overhead variance. Next is, you see, fixed, you see, overhead variance. The difference between actual fixed overhead costs and budgeted, you see, costs. Now, what are the steps in, you see, variance analysis? First step is, you see, set standards, establish standard costs and revenues based on budgets, historical data, and expectations. The next is measure actual performance, record the actual costs incurred and revenues, you see, earned. Next is calculate variances, compute the difference between the actual and standard, you see, cost, revenues. Variances can be, you see, favorable. If they are favorable, we denote them by F. When actual costs are less than the standard costs or actual revenues are higher than the expected revenue, so then it is favorable. Then variances are favorable. Next is variances are favorable. When variances will be unfavorable? When actual costs are higher than standard costs or actual revenues are lower than expected. We were expecting more revenue, but actual revenue is less. So similarly, actual costs are, you see, higher than standard costs. Then things are, you see, unfavorable. Next is analyze, you see, variances. Investigate the reasons, you see, behind significant variances, you see. What are the reasons why this difference is there? If there is significant difference in there, then if very little difference is there, it is all right, negligible. But if major difference is there, then why these differences occur? What is wrong? Did we make, you see, wrong budget? This could involve, you see, examining price changes, inefficiencies, or you see external factors. So it can be due to price changes. You see, price have changed. Next is inefficiency. There is a inefficiency you see in the system. And last is you see there are external factors, not internal. You see factor. This inefficiency is internal factor. We can correct it. Then take corrective action. Now, based on the analysis, you see, in the analysis we have got the reasons, we have found out the reasons. Management can take steps to address unfavorable variances or replicate favorable, you see, outcomes in the future. So, whatever has happened is all right, but in future, you see, it should not happen. So, management takes the decisions after studying this, you see, variances. Now, importance, what is the importance of variance, you see, analysis? What is the importance? Next, the first thing is cost control. By identifying where costs are developing from the plan, management can take action to control or reduce, you see, costs. So by identifying where costs are, you see, deviating from the plan, management can take, you see, action to control or reduce the cost. Next is, you see, performance evaluation. Variance analysis helps in assessing the performance of, you see, departments, processes, and you see employees against predefined, you see, standards. If the employee, suppose some employee is not performing well, so we can issue a letter to the employee. We can give him a, you see, chance to improve. And if the, you see, employee is not improving after, you see, giving him instructions, then we can terminate his services also. You see, we can terminate the service of the employee. Similarly, you see, performance of department, why a particular department is not performing. So variance analysis, you see, will help in assessing that. Then also processes, you see. So processes, how can we, you see, improve the processes? So next is, you see, budgeting. Inside from, you see, variance analysis can inform future budgeting process, you see, leading to more accurate financial planning. You see, in any company, you see, this financial planning, cutting down the cost, you see, budgeting, it helps the management, you see, to increase the profit, take decisions accordingly, increase production. The next is decision making. It provides, you see, valuable information for strategic, you see, decisions such as pricing, production levels, and cost, you see, managing the cost, you see. Then pricing also, you see. If the pricing is, you see, little increased, what will happen? Then production levels also, how can, you see, production be, you see, increased without much increasing the cost, you see. All these, you see, then cost management, you see, all these things, you see, management will take, you see, decision after getting the information, you see. After this variance analysis, you see, management will take the decision for, you see, pricing, for production levels, and for cost, you see, management. Now, what are the challenges We have studied the, you see, benefits. Now we are studying the challenges. What are the challenges of variance, you see, analysis? First challenge is accuracy of standards. You see, if the standards set are, you see, unrealistic or outdated, the variance analysis may not provide meaningful insights. If the budgeted figures are, you see, unrealistic or outdated, you see, standard set, variance, if we'll compare them with actuals, you see, variance analysis may not provide meaningful, you see, insights. There will not be of much use of carrying out this study. Next is complexity. In large organizations, variance analysis can become, you see, complex due to the volume of data and the interrelation, you see, between various, you see, cost factors. So in large organizations, various analysis can become complex. You see, it will not be much useful to them due to the volume of data. Volume of data is, you see, big, and the interrelation between, you see, costs. Then third is interpretation. Not all variances, you see, indicate a problem. For example, a favorable, you see, material price variance might result from purchasing lower quality material, which could lead to other issues. You see. Now, a favorable material price variance, you see, where a lower quality material is purchased, you see, for favorable material price variance, you see, it will result because the lower quality material was purchased. Just to get, you see, favorable material price variance, you see, lower quality material was purchased, but that could lead to other issues, that could lead to other problems. So this we have to take into consideration. Now, let's take a simplified example of manufacturing company. Standard data is, you see, standard material cost is $5 per unit. Standard labor cost is $10 per hour. Standard usage is, you see, 1000 units of material, 200 hours of labor. This is the standard data. But the actual data of the company, manufacturing company, is actual material cost was, you see, $5.5 per unit. The cost increased, you see, by $0.5. Actual labor cost, you see, the labor rate was less. It reduced from $10 to $9 per hour. Standard usage was earlier 1000 units, but actual usage is, you see, 950 units of material and 220 hours of labor. Whereas according to standard, you see, data, 1000 units of material and in that 200 hours of labor. But here, you see, actual, the units are, you see, reduced, but the labor hours are increased, you see. Now, material variance, price variance, you see, actual price minus standard price into actual quantity. Actual price is 5.5 minus 5 is standard price into units 950. It is $475. It is unfavorable. Now, material usage variance, this was MPV, unfavorable. MUV, actual quantity minus standard quantity, 950 minus 1000 into standard, you see, price 5. So we get minus 250, you see, dollars. This is favorable. This is favorable. Next is, you see, labor rate variance, LRV. Actual rate minus standard rate into actual hours. Actual rate 9, standard rate 10 minus 9 minus 10 into 220 is equal to minus $220. This is favorable. Now, labor efficiency, you see, variance, LEV. Actual hours minus standard hours into standard rate. Actual hours, you see, 220, standard hours 200 into standard rate multiplied by 10 is equal to $200. It is, you see, unfavorable. By performing voice analysis, the company can see that while they saved money on labor rates, they spent more on materials than expected and used more labor hours than planned, indicating potential areas for improvement. Next is, you see, budgetary and budgetary control in cost accounting. Now, what do you mean by budgeting? It refers to the process of preparing a detailed financial plan, you see, that quantifies future expectations, you see, and actions, you see, relative to acquiring and using resources over a specific period. It is a critical component of cost accounting as it helps business plan their operations, set financial goals, and allocate resources, you see, efficiently. So every organization, you see, it wants to increase the, you see, it wants to increase the profit. At the same time, because of a lot of competition, it wants to give the, you see, better product compared to other, you see, businesses in the same field. So budgeting, you see, refers to the process of preparing a detailed financial plan. Detailed financial plan we have to prepare while doing budgeting. That quantifies future, you see, expectations. What are the expectations and actions for, you see, fulfilling those expectations? What actions are to be taken relative to acquiring and using resources over a specified, you see, period. It is a critical component of, you see, cost accounting as it helps businesses plan their operations. Business will have to plan their operations, set financial goals. They have to set financial goals, you see, and allocate the resources efficiently. Next is, you see, budgetary control. It involves, you see, comparing actual financial results with the, you see, budgeted figures. Actual results, financial results with the budgeted figures. What were our budgeted figures? Analyzing variances, why these differences are there. And taking corrective, you see, actions where necessary. See, if the differences are in favor, it is good. You see, it is good for the, you see, company. And if the differences are not in favor, then yes, they have to study that what is wrong It ensures that the organization's resources are used as planned and helps in controlling, see, cost. So budgetary control involves, comparing actual financial results with the budgeted, figures, analyzing, variances, and taking corrective, actions where necessary. It ensures that the organization's resources are used as planned and helps in controlling, costs. Now, what is the purpose of, budgeting? Why we do budgeting? Resource allocation. Budgets help in, allocating resources effectively to various departments or functions within the organization. No resource should go waste. Then the resource allocation. Resources are allocated to various, departments or functions within the organization. The resources are now, distributed. Planning. Budgets provide a financial framework for the organization's operational plans, helping to anticipate future costs and, revenues. They have to do planning. Then next is, coordination. Budgeting ensures that all departments, they work towards the common financial goal of the organization, that is giving good product and, increasing profits. Then next is, performance, evaluation. Budgets, provide a benchmark against which actual performance can be measured. Then next is, control. Budgets help in controlling costs by setting limits and guidelines for spending. So we have seen what is the purpose of, budgeting. The purposes are, resource allocation. Budgets help in allocating resources effectively to various departments or functions within the organization. Next purpose is planning. Budgets provide a financial framework for the organization's operational plans, helping to anticipate, future costs and revenues. Next is coordination. Budgeting ensures that all departments work towards the common financial goals of the organization. Performance evaluation. Budgets provide a benchmark against which actual performance, can be measured. Budgets Budgets help in controlling costs by setting limits and guidelines for spending. Types of, budgets in cost accounting. How many types of budgets are there? This operating budget includes budgets related to day-to-day operations, such as, sales, production, and direct material, budgets. Now, production cycle. Now, suppose we start, production today. So today, our raw material, opening stock, labor, they will start, in the factory producing, they will start production. Now suppose, they have, manufactured 10,000 units in, 1.5 months. Now these 10,000 units, you see, company has, you see, uh, sold, you see, and it takes time also. So we can say that, say, 15 days, you see, uh, are, you see, used for, you see, selling these goods. So now from 50, after the sale, you see, now company will follow for, you see, money for payments. So payments, you see, takes about, you see, 1 month. So the production cycle of that particular product is, you see, 10,000 units, it is 3 months. So right from the day of production and till the realization of, you see, sales money, that is one production cycle. So if it is a 3 months, so in a year there can be, you see, four production cycles. So you can, you see, manufacture 10,000, 10,000, 10,000, 40,000, 40,000, you see, units of that commodity you can, you see, manufacture. And you see, suppose in one, you see, in the first cycle, production cycle, you needed working capital, say, you see, 1 lakh rupees working capital. You needed 1 lakh capital. And in 3 months, you will, you see, uh, receive, you see, sales money. So again, you can start production. You see, again, you can start, you see, production. So you have to, you see, make budgets, and then you have to see that how much, you see, actual expenses were there. So operating budget means, you see, it is concerning the operations, you see, includes budgets related to day-to-day operations, you see, sales, production, direct material, you see, budgets. Then capital budget involves, you see, planning for long-term investments in assets such as machinery, buildings, and technology. So capital budget, you see, involves planning for long-term investments in assets such as, you see, machinery, buildings, and, you see, technology. Then cash budget, you see, focuses on the inflow and outflow of cash. You see, how much cash has gone out, how much cash has come in, ensuring that the organization has sufficient liquidity to meet its obligation. You see, at any point of time, organization should have cash. Suppose it has to made a, you see, payment immediately, already committed, and if there is no cash, then how it will do? So company has to maintain, you see, sufficient liquidity all the time. The organization has to maintain, you see, sufficient liquidity all the time. Now next is, you see, master budget, a comprehensive, you see, budget that consolidates all other budgets, providing an overall financial, you see, plan for the organization. So we have seen, you see, types of budgets: operating budget, you see, then capital budget, cash budget, and master budget. So operating budget includes budgets related to day-to-day operations such as sales, production, and direct material budgets. Capital budget, you see, involves planning for long-term investments in assets such as machinery, building, and technology. Then cash budget focuses on the inflow and outflow of cash, ensuring that the organization has sufficient liquidity to meet its, you see, obligations. Then next is, you see, master budget, a comprehensive budget that consolidates all other budgets, providing an overall financial plan for the, you see, organization. Now we come on the next, that is steps in budgeting, you see, process. Setting objectives, define the financial goals, you see, that the organization aims to achieve. What are the financial goals of the organization, you see? Then forecasting, estimate future revenues, you see, costs and other financial variables. based on historical data, market trends, and assumptions. You see. Sales, you see, estimate future sales. Then budget preparation. Develop, you see, detailed budgets for various departments and activities, ensuring alignment with the organization's, you see, objectives. Then approval, you see, present the budget to the management for review and approval, you see. Now, implementation, you see, execute the budget by allocating resources according to the plan, then monitoring regularly, you see, compare actual performance against the budgeted figures to identify, you see, variances. For example, in a organization, they have kept some money for the welfare schemes for the staff. See, say staff benevolent scheme, staff, we see benefit, some schemes for the benefit of the staff. So then you see they have allotted, you see, this much, a particular amount they have allotted for, you see, in the budget, and accordingly, you see, throughout the financial year, you see, money is spent for that, you see, purpose. So actual money spent for that, you see, should be, you see, near the you see, planned, near the budget level. So when the budget was given, say for example, you see, 15 lakhs, so spent amount should also be around, you see, 15 lakhs. There should not be, you see, lot of difference between the budgeted figure and the actual, you see, figure. Now, budgetary control mechanisms. What are the budgetary control, you see, mechanisms? The mechanisms are, you see, variance analysis. A key tool in budgetary control, you see, variance analysis involves, you see, comparing actual results with budgeted figures to identify differences. So in a you see, in a company also, production, they had planned there that in this particular year our sales are going to be, you see, 1 crore, but then they could achieve only 80 lakhs, you see, sales. You see, they were left behind, you see, 20 lakhs. Then they will search what happened during the year. Why we could not, you see, reach our target? Why we could not, you see, when we could achieve 80 lakhs, why did not we achieve 1 crore, which was our, you see, target? So then they will come to know where they have gone, you see, wrong. Certain areas, you see, certain places, they did not do the advertising of their, you see, products. So people of that area did not, you see, purchase. So variance analysis, a key tool in budgetary control. Variance analysis involves comparing actual results with budgeted figures to identify differences, variances. Flexible budgeting adjusts the budget according to changes in activity levels or other variables, making it more, you see, adaptable to real, you see, world conditions. Then standard costing involves setting standard costs for products or services and comparing them with actual costs to control, you see, expenses. Then next is, you see, responsibility, you see, accounting assigns budgetary control to specific managers, you see, holding them accountable for the performance of their respective departments. You see, why the budgeted figures were not, you see, achieved. So they will make accountable specific managers who were holding, you see, whose responsibility was there for the performance of their respective, you see, departments. Department heads will be, you see, asked. So they have to pass on, they have to give the responsibility, you see. Now, importance of, you see, budgetary control in cost, you see, accounting. Importance of, you see, budgetary control in cost accounting. Cost control helps in monitoring and controlling costs by identifying and addressing variances promptly. Then next is efficient resource utilization. Ensure that resources are, you see, used efficiently and if efficiently to achieve the organization's goals, you see. Now, a small example, you see, we give, suppose in a company, you see, they are having, you see, 100 staff is there, 100 staff. Now, they have sold the goods on credit. They have to, you see, recover from, you see, money from many parties. Now, all these 100 people, they may be having, you see, different posts. Some will be working at, you see, officers level. Some will not be working at, you see, officers level, below that, you see, level. Now, if they employ all these 100 people for recovery of debts, they give the work to all these 100 people that you go to, you see, the people who, you see, have to pay their, you see, bills to us and collect money from them. So when all the 100 say, they will say that just half an hour you take out while, you see, your duty is up to 5 o'clock, you go at 4:30. But meet one, you see, person who has to give money to the company. So like this, they are, you see, they are using, you see, they are maximum using the staff. And you see, when people will visit the customers who has to pay the money to the company, they will definitely, customers will come and pay their money. They will clear up their deals, you see. So here you have utilized the staff also fully. So decision making, next is provides accurate financial information that aids in making informed, you see, decisions. Then next is, you see, financial discipline. Encourages, you see, financial discipline across the organization by setting spending limits and guidelines, you see. Now, performance, for example, you see, say there are 100 people, company is giving Diwali gift to all the 100 staff, you see. If suppose they have to control expenses, they should not spend much on this, you see. Of course, they should give gift, but not, you see, costly gift. Next is, you see, performance management helps in evaluating the performance of departments and managers, contributing to overall, you see, organizational, you see, efficiency. Next is, you see, challenges, you see, in budgeting and budgetary control. Forecasting accuracy. Difficulty in predicting future financial variables can lead to, you see, inaccurate budgets. Rigidity. Budgets, you see, may become rigid, making it difficult to adapt to changes in the business environment. Then time consuming. The budgeting process can be time consuming and may require, you see, significant effort from various, you see, departments. Then behavioral issues. Employees may manipulate budgets or underperform if they feel the budgetary controls are too stringent, you see. So they may underperform, they may do less work if they feel the budgetary controls are, you see, too stringent. Best practices for effective budgetary control. Regular monitoring, frequent review budgetary performance and adjust plans as needed. Then involvement, engage all relevant stakeholders in the budgeting process to ensure buy-in and commitment. Realistic budgets, you see, ensure that budgets are realistic and based on accurate data and assumptions. Use of technology, leverage, you see, budgeting software and tools to streamline the budgeting process and improve accuracy. Training, provide training to managers and employees on the importance of budgeting and how to effectively use budgetary control tools. So, budgeting and budgetary control are fundamental aspects of, you see, cost accounting, essential for planning, controlling, and evaluating an organization's financial performance. When implemented effectively, they help in optimizing resources use, controlling costs, and achieving financial objectives. However, success depends on accurate forecasting, you see, regular monitoring, and the involvement of all, you see, relevant stakeholders. Then next is, you see, cost volume profit analysis, CVP, cost volume profit analysis. Now, cost volume profit analysis, what is this? Cost volume profit analysis is a fundamental tool in cost accounting that helps managers understand the relationship between costs, volume of sales, and profit. The relationship between cost, volume of sale, and profit. These three things. It provides, you see, critical insights into how changes in cost structure, sales volume, and pricing affect a company's, you see, profitability. Now, cost components of CVP analysis. CVP analysis revolves around five key components. Number one component is, you see, sales price per unit, the price at which each unit is sold to customer. You see, sales price per unit. Then variable costs per unit. Which are the variable costs? Costs that change directly with the level of production of sales, such as raw material, direct labor, and variable overheads. These are variable costs. Fixed costs are fixed. Total fixed costs, costs that remain constant regardless of level of production. You produce less or you produce more, these costs remain same. Or sales such as rent, salaries, and depreciation. Sales volume, the number of units sold. Profit, the financial gain made after subtracting total cost from total, you see, revenue. What profit was made. To apply CVP analysis effectively, several assumptions are made. The first assumption is, you see, constant sales price. The price per unit remains unchanged regardless of the number of units sold. Price will remain same. Number two, constant variable cost per unit. See, variable cost per unit are constant. They are not changing, meaning that they do not change with the level of production. Then constant fixed cost. Fixed costs remain unchanged within the relevant range of production or sales volume. Linear behavior, both total costs and total revenue behave linearly, implying a direct proportionality between sales volume and revenue cost. Symbol product or constant sales mix. CVP analysis often assumes either a single product or a constant sales mix when dealing with, you see, multiple products. So we have seen the assumptions of CVP analysis. The first assumption is constant sales price. The price per unit remains unchanged regardless of the number of units sold. Constant, you see, variable cost per unit. Constant variable cost per unit. So variable costs per unit are constant, meaning they do not, you see, change with the level of, you see, production. Then constant total fixed cost. Fixed cost also remains, you see, unchanged within the relevant range of production or sales volume. Linear behavior, both total costs and total revenue behave linearly, implying a direct proportionality between sales volume and revenue, you see, cost. Single product or constant sales mix, CVP analysis often assumes either a single product or a constant sales mix when dealing with multiple, you see, products. Now, break-even analysis. A core application of CVP analysis is break-even analysis, which determine the sales volume at which total revenue equals total cost, resulting in zero profit. The break-even point, BEP, can be calculated using the formula break-even point in units is equal to total fixed cost divided by sales price per unit minus variable cost per unit. So total fixed cost divided by sale price per unit minus variable cost per unit. Now break-even point in sales dollars is equal to BEP sales is equal to total fixed cost divided by contribution margin ratio where contribution margin per unit is equal to sales price per unit minus variable cost per unit. Contribution margin ratio is equal to contribution margin per unit divided by sales price per unit. Now, CVP analysis. CVP, you see, can also be used to determine the sales volume needed to achieve a specific, you see, target profit. Target profit in units is equal to required sales units is equal to total fixed costs plus target profit divided by contribution margin per unit. Target profit in sales dollars is equal to required sales is equal to total fixed cost plus target profit divided by contribution margin ratio. Next is, you see, margin of safety. The margin of safety measures how much sales can drop before the business reaches a break-even point, you see. It indicates the risk level associated with the current sales volume. Margin of safety in units or dollars is equal to margin of safety is equal to actual sales minus break-even sales. Margin of safety ratio is equal to margin of safety divided by actual sales. Now we come on, you see, next. Application of, you see, CVC analysis. CVC analysis is widely used in various, you see, decision-making scenarios, such as, you see, pricing decisions, you see, understanding the impact of pricing changes on profitability, you see, how much price we have to keep, you see, so that, you see, we arrive at this much profit. So CVP analysis, you see, helps us to take decision about, you see, pricing decisions. The next is, you see, CVP analysis is widely used in various decision-making scenarios, such as, you see, cost control. Analyzing the effects of fixed and variable cost changes on the bottom line. So how we can control the cost? What shall we do so that the cost may not, you see, you go beyond this? You see. Then product line decisions, evaluating the profitability of adding or discontinuing, you see, products, which product to continue, which product to, you see, discontinue. If the sales are not picking up, maybe, you see, in the market some other companies same product is available, so that is better than your product. So drop, better to discontinue that product, you see. Then make or buy, you see, decisions, determining whether to produce in house or outsource. This is also, you see, very important. Say, for example, this in shoes, you see, leather soles are available very cheap in Taiwan. And you see, many shoe companies, what they do, they purchase, they import soles from Taiwan, and then they make the top portion in their factory. They make, and then you see, after stitching, the shoe is ready. Shoe is ready. So it costs them less because they have imported the sole from Taiwan. You see, and the price at which they got is very less, you see, compared to the price which they would have, you see, paid in bringing you see, this sole portion in our country. Next is, you see, budgeting and forecasting. You see, setting sales targets and, you see, preparing budgets based on, you see, desired, you see, profit levels. So sales target, you see, we have to set, and accordingly we have to arrive at the actual, you see, figures. We have to do the, you see, hard work. Company should do hard work, you see. Company should employ sufficient staff for the sales, you see, so that the targets are, you see, achieved. Naturally, if sales targets will achieve, so accordingly the profit, the budget, the profit which is anticipated will definitely be, you see, achieved. If sales targets are not achieved, naturally, how can, you see, the company expect to achieve the profit which was, you see, desired while setting, you see, sales targets. So sales, you see, boost sales, increase sales targets, you see, arriving at sales target, that is very, you see, important. So budgeting and, you see, forecasting. So setting, you see, sales, you see, targets, and preparing, you see, budgets based on desired profit, you see, levels. So next, our, you see, slide is about limitations of CVP analysis. Despite its usefulness, CVP analysis has limitations also, you see. Simplicity, the linear assumptions might, you see, over simplified real word complexities, you see. Next is short-term focus. CVP is more applicable for short-term decision, you see, making. Then single product focus. When dealing with multiple products, the analysis assumes a constant sales mix, which may not always be realistic. Ignoring, you see, external factors. So it does not consider external factors like market conditions, see, competition in the market, you see, and economic changes that could affect costs and sales, you see. And you see, in this slide we have studied, you see, limitations of CVP analysis. Despite its usefulness, CVP analysis, you see, has limitations. You see, simplicity, the linear assumptions might oversimplify real world complexities. Short-term focus, CVP is more applicable for short-term decision making. Single product focus, when dealing with multiple products, the analysis, you see, assumes a constant sales mix, which may not always be realistic. Then ignoring external factors, it does not, you see, consider external factors like market conditions, you see, competition in the market, and economic changes that could affect, you see, cost and sales. So CVP analysis is a powerful tool in cost accounting for assessing the relationship between cost, sales volume, and profit. By understanding its components, applications, and limitations, managers can make informed decisions that enhance profitability and manage risk effectively. We are closing the session. Thank you very much, students. Thank you very much.